Hey, everybody. Welcome out to night number one of your Option Strategies virtual workshop. My name's Scott Durfey. I want to be the first to welcome you out tonight. I will be introducing you also, probably not much of an introduction necessary, but for my good friend, Mr. Ray Kimbrell, we'll bring him on here in a minute and get him involved in this as well. But before we get this started, we've got a lot to cover tonight. So I'm going to whip through some of these housekeeping items so that we can get right to the content this evening. So first off, welcome. We love that you're here. We're grateful for the opportunity to be able to provide this in such a way that allows all of you to be here. We just got done, Ray and I and others just got done in San Diego. The week prior to that, we just got done. We were done just getting done in Santa Clara, California as well. So we know that it's not possible or probable that all of you are able to attend those types of workshops. So every once in a while, we're able to provide one in a virtual setting. That's what we're doing here tonight. So welcome. We're grateful that you're here. In preparation for the workshop tonight, when you registered, you were able to pre-submit some questions, some things that maybe could help kind of provide guidance and direction for the conversation tonight. And we got them. And we actually have taken those. We live in a technical world today. You know this, we know this. So we were able to, through technology, compile all of your questions, and we were able to kind of break them down into 5 categories. Let me tell you what they are quickly. We'll be pointing these out as we go through the workshop. But number one, teach me options from the ground up. We'll be doing that, and we'll begin that process this evening. Another one, the second one, and these are in order of popularity, right? So the second most popular idea was, can you explain Greeks and can you do it in a way that's simple and practical, especially delta and theta? And Ray's going to do that for us this evening as well. Can you show me how to close a contract? That was number 3. We'll be doing that. We'll be doing that every night, I think. We'll be closing contracts. So an opportunity for you to get those expectations and your requests met there as well. And then number 4, can you show me how to place and manage a trade? Oh yeah, we're going to start that as well again this evening. So prepare for that. And then the 5th one, can you help me avoid losing money? And of course, this question revolves around risk management, etc. A really important question, and we'll definitely be talking about that as well. So tonight we'll be covering the first section of this virtual workshop. This will be going for 4 evenings or afternoons, depending where you are. I guess mornings potentially even, depending on where you are. But we'll be going for 4 evenings. And then actually we're going to add a 5th evening with a Q&A session. And in that Q&A session, you'll have the opportunity throughout the event to go into the event hub. The event hub is linked to you in your registration material that you receive via email, etc. So within the event hub, you can go in and submit questions for each one of these nights. We ask that you do submit them for the night for the corresponding night to the question. It helps us as we sort through them, etc. So we expect that to be a really great experience as well. There's one of we have a really great coach, manager. He's been with the firm for many, many years, at least as long as Ray and I. Scott Thompson, he's in the chat right now. He'll be answering your questions and commenting to them as he can. Now, I will forewarn you, and I've got to give him a little backup here. There's one of him. And as amazing as Scott Thompson is, and he is indeed amazing, but as amazing as he is, there's no possible way that he will be able to answer every single question or comment on every single comment and question that comes through the chat tonight. So please be patient with him. We give him tip our hats to him and give him our deepest and sincerest thanks for being here with us this evening. Let me just remind you that everything that we're going to be doing tonight will be for educational purposes only. You do need to know, we're talking about options tonight. You do need to know that options carry a high level of risk and are not suitable for all investors. Also, we'll be using a paper trading, a paper money account. It appears as though it's a real account, but it's a paper money account. When you trade in your paper money account, you need to know that those accounts do behave differently than a real live cash trading or any other type of real live trading account. There's just some differences in terms of fills and costs and various things like that. So keep that into consideration as well. Again, we're not giving any recommendations here. Everything that we'll be talking about tonight will be for educational purposes only. So you're going to have two of us tonight. I've got my good friend, Mr. Ray Kimbrell. He'll be joining us this evening as well. I'm going to introduce him here, and then we'll be taking it from there. So, my good friend, Mr. Ray Kimbrell. Ray's been with us since 2004, managing events, speaking at events, etc. Been doing these virtual workshops. During this time, he's also instructed our stock and options classes, our technical analysis live person events. He's helped with the advanced option events, etc. And prior to all of that, one of the cool things, and Ray's one of my favorite people. We really are good friends. But one of the really cool things about Ray is Ray, prior to entering into the corporate world, served 10 years in the United States Marine Corps. And I'm especially grateful for that, especially this year, 250th anniversary of the countries. Thank you very much for your service there as well, Ray. He loves teaching. He loves all things outdoors. Pretty good, darn good family guy as well. Ladies and gentlemen, let me just give you Ray Kimbrell.
All right, thank you, Scott Durfey. I appreciate my friend, and back at you with another great friend. Like you can't call it work when you go to work, sort of work with your best friends out there and having fun. So that's what we do. It's kind of cool, and uh, and so with that, I want to say thanks for those accolades, Scott, and thanks for the shout out for the Marine Corps. Once you're Marine, you're always a Marine. Hoorah, semper fi. All right, so let's get Scott introduced here so that we can get this class going. So if you hit that next slide for me, Scott, and I'll bring you up here, and we're rocking and rolling. You can see there, Scott's been doing this again for 1 or 2 days since 2006. He also is a very contributor to that Schwab network, which is brought to us by our separate affiliated company, Schwab Network Media Productions, and he also, man, he's got it with the platform. He teaches technical analysis, stocks, options courses, you name it. He's done it out there. He and I have been doing this for many years together, both virtual and live. He's also quite the family man and proud of it, and we're proud of him as well. And he has got so many grandkids now that they're running out of names. Actually, it's pretty cool. I don't know how they keep them straight, but with that, we get the privilege of Scott starting us off with our options. So, my friend, take it away.
All right, Ray. We're still have enough names for sure. Uh,
Yeah.
we we did though just have number 17, and what a gift. That's really one of the main ways that Deb and I can measure our wealth is through our family. So thanks for that. Gang, I just want to make sure, that as we're going through everything that we're going through here tonight, that we're understanding the things that we're going through. So for that reason, we're going to take it a kind of at a snail's pace for some. If you've been around here a long time and these are going to be reviews for you, be patient with us because we have a lot of us. In fact, if you're new here and this is your first time doing something like this, or you feel new here, even let's say if you rate your experience on a scale of 1 to 10 below a 5, put that in the chat box, will you? So we can kind of get a feel for exactly what it is and who you are, that so that we can know how to speak to this. And this really is going to kind of be our focus tonight, is to just focus on. You can see here, option basics is going to be night number one. So let's just get right into it. Um, let's talk about the goals for this session. First of all, the goals for this session, as you can see, is to learn the basics of an options contract. Now, let me just push time out for just a second. I think many of you are maybe already wondering, how do I get access to those slides? Because these slides are going to have some great information. They'll be important for you. You have access to these slides also in the event hub. That all of your information for the workshop was contained in an email potentially, probably. So go back to the event hub there. Look for it's called a reference guide. a reference guide. And that reference guide is the slide deck that Ray and I will be using all 4 nights. Okay. All right. So the difference between a call and a put, we know there's 2 types of options. Maybe some of you didn't know that until just now, but there's 2 types of options. There's calls and puts. And what's the difference? We're going to identify how buying or selling options can change different trades characteristics. We're going to explore the various ways an option trade can end. Really important. We focus a lot, and when I say we, I mean this is just kind of seems to be the trend. But we focus a lot on how do I get into a trade, and that's exciting and that's wonderful. And sometimes we don't pay as close of attention to how do we exit a trade. And this is going to be extremely important as we're talking about options as it is with anything else. We'll be talking about that in some detail tonight. We're going to also determine how changes in various factors, not just price, but how changes in various factors can impact the price of the option. We'll be doing that tonight. Ray will be taking us through that. We'll hit that at about halfway through the event tonight. Okay, so let's just talk in general. Why do we even trade options? So first off, why am I interested in trading an option? Well, there's 3 potential reasons. One is to generate income. Another one is to speculate on the move of an option. The other one is to potentially hedge or give some potential protection to the downside of an underlying instrument. So 3 main reasons that we use options. But, okay, Scott, but what's an option? An option contract. And when we're talking about options, gang, we're talking about contracts. These contracts are tied to an underlying instrument. And you've heard the word derivative. Options are a derivative. That means that they derive their value from something else. They don't have any organic value. They derive their value from something else. And that something else is what's happening with an underlying stock or ETF. Okay. And so an options contract gives a buyer, when we buy an options contract, and that's what we'll be focusing on tonight is buying. When we buy an options contract, the buyer has the right to buy or sell a specified number of shares of stock or ETF at a certain price. We're going to call that the strike price before a certain date. Okay. So if you can see my, you know what, better than that, let me get my little drawing tool here. So you can see here that there are several things that we need to be paying attention to. One is I have an underlying instrument, ETF, stock, whatever the case may be. It's going to trade in a contract, okay? And this contract that I'm buying gives me the right to do something within a certain period of time. Now, that contract is going to have a attached to it or be a representation or a control of, in these cases, 100 shares of the stock or ETF. There's a premium. Okay, this is the price I pay when I buy a stock option. This is the price I pay for that option. Now, remember, we're talking about 100 shares. This is a per share. And so when we're talking about $1.20 for 100 shares, so one contract of this ZYX option would cost me, the trader, $120 per contract. We're going to use a strike price. Now, this strike price is this price at which the stock or ETF trades at, which will trigger an event, and that event we'll get to in just a few minutes. This has an expiration date. Unlike stocks, if I buy a stock, it doesn't have a built-in expiration date. It's not built in to expire at a certain date. I can buy a stock and I can trade it as long as that stock stays on the exchange, and many of them have been on there for many years. I can continue to trade those stocks. A option always has an expiration date, and we'll get to how to determine those, where to see those, and what all of that means as we go. Okay, so let me clear the drawing set here and move to the next slide. Okay, fantastic. It works great. So 2 types of options. I mentioned this earlier. We have calls and we have puts. When we think about calls and puts, we're going to be talking about rights and obligations. And most of the things that we're going to be talking about tonight, as we get into giving examples, will be in the rights. We'll be buying the right to do something. Over the next nights after this one, we'll also be bringing in selling an option to open a trade, wherein we obligate ourselves. And so let's take a look here. When I'm talking about these options, calls, okay, a call increases in value. When I buy a call option, that call option increases in value as the price of the underlying stock goes up. Okay. And so if that's the case, and think about this, it's like a phone. If I have this is an old example, most of you will still understand this, but if I have a telephone and I receive a call, I will pick it up, call up. Okay. So a call increases in value as the price of the stock goes up. A put increases in value as the price of the stock goes down, put down. Call increase up, put increase down. Call up, put down. So that should be helpful. Now, that's going to come into play as we start to kind of dissect how to differentiate what these various options are and what they look like. But let's begin here with the call. You can see that when I buy a call, and that is often indicated with a plus sign, or we will call that long. We'll reiterate that as we go. But as I buy a call, I now have the right to buy the underlying stock. At what price? At the strike price. I have the right to buy the underlying stock at the strike price that we pre-agreed upon when I purchased that option. Now, when I go into a put, I have the right to sell the underlying stock. So if I buy a put, if I buy a $100 put and the stock's trading at 105, and then it goes down to 90, I have the right to sell it at 100 when it's trading at not at 90, you can see that there's some benefit, and that's where that price or that value of that contract increases. This is a page that's going to be very helpful. The rest of them I'm going to go through here, but I would encourage you to take a screenshot of this or be sure to get this in the reference guide. I know Ray has had this actually printed and hanging on his wall in the past, not because he needed to know it, but because it was there for him to use as his examples as he was going through this. So if I'm a buyer of an option, I have a right. If I'm a seller of an obligation, I have obligated myself. You will understand those obligations as we get into those tomorrow when we start talking about covered calls and short puts. But let's just say if I sell a call, I am obligated to sell the underlying stock at a price, the strike price. If I sell a put, I'm obligated to buy at that strike price. So here's my bias, right? A contract, remember, on a call increases in value when the underlying stock increases in value. A put increases when the contract it gains value when the underlying stock decreases. Okay, so that should kind of help us along a little bit, at least as we're moving through and learning these different types of options. Again, here, this one kind of goes through the long versus short. When I talk about I'm long an option, that means I have bought an option. It really doesn't mean anything. And let me rephrase that. It does not mean anything about my um, bias, bearish or bullish. It just means I have bought the option. So if I am long a call, I bought the call. If I'm long a call, I'm a buyer of the options contract, and I have the exercise to exercise that contract at that strike price. Okay. If I'm long a call, I have the right to buy the underlying stock at the strike price. If I'm long a put, we just went through that. Again, I'm buying the right to sell the underlying stock at that strike price. Again, bearish. Okay. When I'm short, we'll cover this again tomorrow, as I mentioned. I'm the seller of a contract. Just means I sold the contract. I can sell a put and be short the put. I can sell an option and still be short the call. And so I'm the seller. If I'm short, I'm obligated. We talked about that. If I'm short a call, I'm obligated to sell. If I'm short a put, I'm obligated to buy. A short call is therefore bearish. A short put is therefore bullish. Important for us to understand. Okay. So let's talk about calls and puts just to, whoops, sorry about that. Calls and puts just a little bit here, just so that we can kind of lock in these concepts before we go out into the wild, which I'm going to be doing here in the next just few minutes. Um, and then we'll turn it to Ray. So what if, so I'm talking about a call, and I on this particular call, there's two participants, right? We have a buyer and we have a seller. We're going to be focusing on the buyer of this call, okay? So if I'm a buyer of a call, my bias is what? My bias is bullish, right? So if I'm the buyer of a call, my bias is bullish. I'm expecting the price to go up. And so in this case, there's a strike price, and that strike price is 76. What if the price goes to 78? Am I profitable? And by how much? Okay, so I am now become profitable. I move in the money, is what we call that. And as I move in the money by $2, then that, in theory, then that call becomes profitable. What if it falls to 74? Then I'm losing, right? And the opposite's true on puts. I'm going to just fly through that one because we're getting. I think by going into the wild here in just a second, we'll pick those things up more readily. So let's just talk about again to just kind of lock it in the options multiplier on a standard options contract. The options multiplier is 100. 100 shares of stock or ETF is represented or by that options contract. Okay. Now, if that premium is $1.20, like we talked about, that's per share. So we can see that $1.20 times the multiplier, we're paying $120. Important for us to understand how to calculate all that. Okay, let's go to this is where Ray's going to take it. Excited for us to get to that part for Ray, but let's get into Ray. If you want to hop on here with me, actually, as well, I'm going to do a little bit of trading here. We're going to have some fun with making a couple of trades. If I can get to my, there we go. Okay, so gang, Ray will be hopping on here with us. When he's on here with us, we'll have him do some commentary as
I'm
well.
on. I'm listening. They just that my face is up. There you go.
There you go. I just didn't see it. There we go. Okay. All right. All right. Fantastic. So, Ray, what we're going to do here is I want to take a look, and I don't have much time because I don't want to cheat you out of any time, and I want to make sure that we cover this completely or
Oh, we're doing good.
completely enough. You know what I mean? So,
Yeah.
let's take a look at a couple of examples. So let's talk about calls first. I have a couple of potential examples here. Let's take a look at a chart on American Airlines, shall we? So American Airlines. So what do we see? I'm not going to get into a deep dive on technical analysis here, but Ray, what do we see happening on the technical analysis on American Airlines? Just briefly, right
Yes,
there.
I'm glad you're bringing up the technicals. A lot of people think that, when you get into options, you
Yeah,
forget about the charts, but you got to understand, folks, as Scott said, call up, put down, call up, put down. So if you're looking at a chart like this, which is right now in an intermediate term uptrend, it's you got a bounce coming off of a support level. And if you were in a technical analysis class that Scott and I taught, at the end of April, you'd say, okay, that looks like maybe a bullish bounce, right? And
maybe
so,
even a hold, Ray.
yeah, oh, it is a Cahold as well.
Yeah,
And so a bullish bounce on a Cahold, which is a close above the high of the low day, that tends to be a little more bullish.
yeah.
So based off of what you just said earlier, um, call up bullish, I would look at the call sides. All
Okay,
right.
so let's go to the options chain. If I come here to the options chain, how I got to that on the Thinkorswim platform. Now, this is the desktop version of the Thinkorswim platform. If you don't have that downloaded, maybe Scott can drop the link to download that in the chat for us. But there's a Thinkorswim platform download desktop version. That's the one that we're using here. So to do this, I'm going to come right here to the trade tab. I have American Airlines. Now, the way I was able to move between the chart tab and the trade tab and have American Airlines still show up in the box that I use to give us the information is I have them linked. And so if you can see right here where my cursor is, I'm just going to drop that down. You can see that I have a red one here. I'm going to also go to the charts and it also has a red one. Okay. Maybe to just add a little bonus for you here, if I can do the same thing within a watch list. So here I am in the watch list, any watch list that I currently have, I can come up here and I can also put that a red one. So I can come down and move down through these and they'll move as I go. But let's go back to American Airlines and let's go back to the trade tab. And Ray, let's look at this. Let's look at making a trade a bullish trade. So a bullish trade, we're doing what? We're doing potentially buying a call on American Airlines. Now,
All right.
when we do this, we want to potentially give the trade enough time to work. Some traders think, and look at maybe between 35 and 70 days, roughly in there, is a good kind of idea to look at in terms of how far out do I go on my expiration. So on this one, let's just go 39 days out. Let's go to July 17.
So,
Let's,
so Scott, real quick for people are going to space, how do you know it's 39 days out?
thanks, Ray.
Yeah. So right there on that chain, and maybe close the left sidebar real quick, Scotty, so they can see it. And then, so folks, right there on that on the options chain itself, as you go down, and you see that 17 July 26, and there's a 39 in parentheses. That's 39 days till expiration. The ones in 32, the 24, the 18, the 10, and 4, on up, those are days till expiration. Okay, and so that's how you know where you are on your expiration time, and we'll get into that here in a little bit when I get into the Greeks. But that's where Scott's looking at that 39.
Ray, while we're here, because this question is going to come up as well, there are a bunch of letters, gang, right along here. Those letters, and those letters are right along the bid ask. Those letters are a representation, and you can see them on this side as well, and this one as well. Those letters are a representation of the various exchanges. They don't really mean much to us, so don't worry about that. Okay. All right. So Ray, I'm going to go ahead and I'm going to go open up the options chain, which I've just done here. I'm going to, I just had to change a few things here. I'm going to look at which side, Ray. I've got two sides of this. When I open this up, let me go back to July, and I don't know why that didn't clear. I go back to which side do I look at, Ray?
All right, so if you look at the options chain itself, folks, it's pretty generic on all your unless you modified them. But the left side will be your calls. You can see up top there, right in the middle of that, there's a word that says calls, and then over on the right side, you'll see the word puts. Okay, and that's where you're going to find the information with the premium, the bid, and the ask price. I say that carefully. All
Yep.
right. And that's the bid prices, where is the amount you're going to sell the option at. The ask price is the amount you're going to be buying the option in. All right. Whether you're buying to open or selling to open or buying to close or sell to close. We'll get into that in a minute. All right. But those are that's how you come up with your premium. Okay. If you were to click on that, like where Scott's got it highlighted at the money option, that 136, and he clicked on it, it pulled up the option, the order, and that's a buy order because he's on the ask column. That's why it came up as a buy, and it loads the information for the option contract right there for you. Okay.
Okay. All right there. I'm going to go ahead and hit confirm and send. We will read this out loud, and it's important that you do that. In fact, I made this mistake just today, Ray, when I was placing a trade. I didn't read the flipping order, and I got filled with five contracts when I meant to get filled with one. So there you but anyway, here's what we're going to look at. We're going to look at buying one American Airlines. We know it's a standard contract because that 100 is a representation of the number of shares that are being controlled by that. So that just means it's a standard contract, that number 100. It has an expiration day of 17 July 2026. It's the 13 strike. It's a call. It's at $1.36. That's what I'm paying, or That's what I'm offering to pay for this position. Market's closed. I'm going to go ahead and send it, and we'll see if it gets filled tomorrow. So that's a call, Ray. I'm just going to do a put, and then I'm going to give it back to you. I know we're getting right up against time, and I do
Oh no,
not.
you good. You got about 15 minutes.
Okay, we're good then. Let's do this then. Let's do another. Let's do one more call. Let's go to Harley Davidson. Maybe you've heard of them. Not a recommendation to buy or sell, but they really make cool motorcycles, man. Me and Bowen were on ours for a couple hours yesterday, where it was pretty great up the canyon and stuff. So, what's happening with Harley Davidson, Ray? We can see that it's been moving along. It's been bouncing off this level of support. We have another one of those things that rhymes with cahold, right? Right
Yep.
there at the end. And so, what do we expect from a technical analysis standpoint, Ray? What do we expect a stock to do when it's bouncing off of
Yep. So you're currently in an uptrend still. You're bouncing. So I'd say may continue that uptrend. There's no
potentially
guarantees,
continue
but
that
that's
up?
that's
Yeah.
the idea. And so I would say maybe another potential call could be could be in order if that's
Right,
how
well,
you want to approach it.
let's take a look at that then, Ray. So let's go. You'd go to the trade tab, right? You'd come down here. Now, Ray, let's pick a expiration date. What expiration date will we go?
Yep. And so again, many of the things that we talk about, and we'll get into this with the Greeks in a little bit here, but make sure you're giving your option enough time, all right, to get to the expectation, the move that you wanted to do. All
That's
right.
right.
And so, a good rule of thumb is, 20 or, 150 days out, 50 to 150, maybe, 40, somewhere in there,
Yeah.
to give that time for your stock, all right, price to move the direction you want it to move. All
Yeah,
right.
exactly. And there's a perfect example of this is going to become an individual thing. Earlier, I said 35 to 70, Ray saying anywhere from 20 to 40 to 120 or whatever. So this is going to be the important thing is, gang, is you're not going to get a consistent, absolute answer on how far do I go out. The point is you want to give it yourself enough time for the option to work. And when we buy an option, having that option work for us it's always imperative, but it has to do something when we buy an option. It has to move in the direction that we want it to. Ray, let's give this one a little more time. Let's go out to 21 August. That's 74 days.
All right.
Now we want to buy a option potentially. We're buying a call. Now you'll see that these options are shaded. We have some purple shading and we have some black shading. We have some purple shading on the puts and we have some black shading.
Yep.
There's two types of there's two components to option pricing, Ray. Intrinsic and extrinsic value. Can you explain those to us briefly?
Yeah, so a couple of things first. So the purple on this case, all right, and the black on the call side, okay, are known as in the money or out of the money, okay. So the purple ones on this side in the call, the ones that where you see the strike, which is the price at which you're controlling the stock, or the down the middle there, okay. You see 10, 12, 13, 14, 15, right, and it's going down, okay. So you see those on the top side, or the purple shaded area for the calls, are called in the money options. They have what's called intrinsic value. And then the ones that are in the black on the call side are known as the out of the money options, and they have no intrinsic value. All they have is time value. And so Scott is highlighting down that intrinsic value line and that extrinsic value line. So intrinsic value, all right, is simply the strike price, or I'm sorry, the stock price minus the strike price, the difference. Okay. All right. That's the stock price. So in this case, last price traded 24.91 minus the strike. Let's say you did the $20 strike. All right. And that's why you get that intrinsic value of 491. Okay. So it's the stock price minus the strike price. Okay. Intrinsic value. You have value. You're in the money. So one of the things as a option trader, or a buyer of the option, you would like to have your option at expiration to be in the money or have intrinsic value. Okay. Whereas when you have out of the money options, there is no intrinsic value. The only value you have was known as basically time value, all other values out there. Okay. Volatility. All right. All those other things. Okay. Other Greeks, basically. So that's what you're looking for a lot of times when you do this. Okay. Do I have value or do I not have value? So if, as a buyer of an option, the ideal thing, obviously, is you want your option to have value at expiration, okay, or before expiration. So if you get out early, you have value. You've made money. The idea is to, buy the option, the underlying goes up. If you bought a call, your call increases in value and you can get out of it. You don't have to hold it to expiration. That's one of the main things that a lot of people forget about. All right. Just because you bought an option that's 74 days away doesn't mean you have to hold it for all 74 days.
Right.
Okay.
Yeah. Yeah. Exactly right, Ray. So let's go ahead and pick a strike price. It makes sense to a lot of traders based on what you just said to have a option that has intrinsic value is sometimes a preferred by some traders method of doing this. So let's just take a look at potentially doing that. Let's go one strike in the money. There's at the money, or there's in the money and out of the money. We've just talked about those. Out of the money is extrinsic value, in the money, intrinsic value. And then there's this concept called at the money. The at the money is the strike price that is mathematically closest to the mark price of the current mark price of the stock. Okay, so when we're picking this strike price, many traders will look at the money or in the money, one strike, maybe two strikes in the money when they're buying or being long an option, whether that's a call or a put. So we're buying another call here. Let's go ahead and we're going to take a look at the 24 strike ray. I'm just going to go ahead and right click that. I'm going to come up here to where it says buy. I'm going to come up here to where it says single because I'm not doing any of these, more complex strategies on this particular one. I'm just going to go ahead and click on single. I'm going to come over here and read across it. I've got 5 contracts going out potentially on this one. It's $24 strike price. I'm paying $2.80 per share to engage in this. This is a limit order. We will see if it fills tomorrow. A limit order means that price or better. So if Harley Davidson goes high tomorrow, we may not get filled. If we really want to get filled, and let's do that. If we really want to get filled, regardless of what happens tomorrow, and you have to be really careful doing this using market orders, right, Ray? Because you don't know if it's going to go down or up, but you could just click on that market order, hit confirm and send, and you'll buy it at the next available price. Going overnight, we're going to just go ahead and go back to the day order, and I'm going to go ahead and hit confirm and send. Now, this does not have time in, actually, it does have time in for. I'm going to go back to a limit order. I'm going to make it for the day. I'm going to go ahead and hit confirm and send. We're buying 5 Harley Davidson 100, so that's a standard contract to 21 August of 2026. That's the expiration date. $24 call at 280 limit to open. We have a maximum profit on this as infinite, right? Infinite. A lot of times and that's the case on calls, and that can be very compelling to traders, but don't let that pull you in. That's the case on all of them. It would have to go all the way to infinity in order for that to be the case. This is going to cost us $1,400 potentially if we get filled at the limit. Could be better. $1,400. Our maximum potential loss on this particular option contract itself, just the option contract itself, the most we can lose on that options contract is $1,400. I'm going to go ahead and hit send. All right, Ray, let's do one more trade. I think of one more trade. This one's going to be a put. Now, if I buy a put, my bias for a put is potentially bearish. Now, when we talked about trading options earlier, we said that we can do it. We typically do it for 3 different reasons, right? To make money, to speculate, to hedge. And so as we hedge, what does that even mean to hedge? Let's take an example potentially of that. I'm going to come up here to my monitor tab right now. In my monitor tab, it's going to show us the positions that this particular account has in it. Now, this account is a demo account. It's not my live personal account. I don't have $17 million in my live personal account. Okay. So I have within it, you can see that I have a couple of positions where I have some options. I own Gilead, for example. I own 5 puts on Gilead. My trade price on that was $9.20. It's currently trading at 8.80, so I'm down a little bit overall on that particular one. Now I have 5 contracts there. I would want to potentially wonder, do I have the same conviction that I did today that I did when I entered this trade? And I can take a quick glance at potentially looking at that by going right up here to the charts and putting in Gilead, GILD, and taking a look. Okay, so what's happening here? And just quickly from a technical analysis, I'm in an intermediate downtrend. I am bouncing off of a level of support, but just below it, this old support was old, new support was old resistance, and it could break down through it. In fact, it's moving in that direction. I have some red candlestick patterns, etc., showing me that potentially, not a recommendation, but potentially a bullish move could be happening with Gilead. But it is my conviction enough to completely take off my entire position. Maybe not. And so, what can I do instead? Well, what I can potentially do instead is I can come here, and again, I go back here. I have five, five contracts in Gilead, and I can come here. I can create a closing order. Now, I just right clicked and I come right over here and I can go to sell Gilead. I'm closing this put. Now, this is a put. What am I selling? What am I closing? And I know I'm selling it because it's red. I'm selling a single and it says sell. And it says that I'm selling 5. I maybe don't want maybe I just want to scale out a little bit and keep a few in there in case it does bounce, because maybe it does. Maybe my conviction's a little bit wishy-washy. So I'm going to increase that to, I'm going to sell 3 of those contracts potentially. Okay. This is the contract that it is. I'm just closing the order that was there. I want to close it at the limit price. I'm going to go ahead and hit confirm and send. I'm going to read the order. Sell 3 Gilead 100, 17 July 2026, 135 put at 795 limit to close. I'm going to go ahead and hit send. And now I have closed the put. But I own, let's see if I can do this in just a couple minutes, Ray. I own a bunch of shares in this particular, um, do I own shares? I own 500 shares of NVIDIA in this particular account as well. So let's go ahead and look at NVIDIA. NVIDIA, I do have some threatening movement. I have some threatening movement. But maybe I don't want to sell my shares. Maybe I just want to get some protection. Now, if I were to buy a put and a put increases in value as the price of the stock goes down, if I'm in anticipation of NVIDIA stock going down, but I don't want to sell it, could I gain from the movement of the to the downside by owning a put, also known as a hedge? So I potentially gain as this price of the stock moves down, potentially, maybe not completely, and maybe a little more in some cases, but potentially offsetting some of the price movement to the downside on the stock itself. So if I'm going to do that, I'm just going to buy a put. So here we are with NVIDIA. NVIDIA, go to the trade tab. We're going to do this just like we've done the others. I'm going to go out a little further on this one. I'm going to go out 74 days to the 21 August. I'm going to buy a put. I'm going to buy a put. I'm going to buy a put that has some intrinsic value. I want it to be in the money. I have changed my layout to where it shows position and intrinsic value. So you will see here, here's the position if I had one. Here's the intrinsic value on the strike price. Here's the extrinsic. So if I come down here and I look at the 210, I can see that I have $1.89 in intrinsic value on that strike price. I'm going to go ahead and buy that strike price. Click right there. I'm going to buy. Now I'm buying this as a hedge to the downside. I have 500 shares. If I want to match it share to share, then I would buy how many contracts? Five, because 100 shares per contract. Let's go ahead and do that. I'm paying a premium for that. I'm paying $15.55 for that protection. So these are things that I have to take a look at and make sure they make sense. Why would I want to do that? There's a lot of reasons. People don't want to sell stock, especially those that they've been hanging on to potentially for a long period of time. Let's go ahead and hit confirm and send. I'm buying five. NVIDIA, it's going to cost me $15.55. I am spending $7,000 for this protection on the downside. I'm going to go ahead and hit send. And there you have it. Now it shows that I have a buy order in at that strike price right there on NVIDIA. So, all right, gang, that's a lot to cover in just a little bit here. But what I want to do, Ray, I don't know. There we go. What we've talked about in this section, we talked about the basics of an option contract, the difference between a call and a put. We identified how to buy and sell options. We explored various ways an options can end. Um, we're going to talk more and more about that as we go, too, gang. We're going to determine how changes in various factors can impact the price of an option, etc. So, I mentioned earlier that we have, I don't know how many of you feel like you're 100% comfortable and confident in the Thinkorswim platform. When it comes to options trading, this is among the top, and in my unbiased opinion, it is the top trading platform out there for especially trading options. Really cool to get to know it better. If some of you feel like you're just not at the level of understanding that you would like to be with it, this is a perfect opportunity. Go ahead and just either click that QR code or copy that bit.ly link in the bottom. What you have here, the opportunity here to do, and many of you I know have taken advantage of this, but this is a one-on-one conversation with one of our Thinkorswim experts to kind of help you set up your Thinkorswim platform the way you want it. What it is, so it's a lot of good things, education, course discussion and planning, one-on-one conversation on how to optimize your Thinkorswim platform, how to customize it, etc. What it is not is they will not spend time talking specific strategies or stock recommendations. So manage your expectations there. And they will not be doing technical support. We have other resources for that as well. Now, one thing I will ask you to do, number one is please everybody sign up for that. And number two, please everybody, when you sign up to that, realize that by signing up to that, you're taking a spot that may not be available for somebody else. So if you sign up for it, make sure that you keep your appointment for whatever unforeseen reason arises. And we understand that they do. Please go ahead and cancel it before that time comes up as well. Additionally, as I mentioned, we just got back from San Diego teaching a technical analysis class on day one, and we taught the entirety of this week's virtual workshop on day two. We'll be repeating that process again in Chicago, Illinois on July 17 through 18. Get registered for that. Following that, we will be in Dallas, Texas for a one-day market drive. Following that, we'll be down in Orlando, Florida in August at the Gaylord Palm Resort. What a great property. So, great destination, great time to go to Orlando. If you haven't already signed up, I'm sure that it's filling up fast, so please take advantage of that. Okay.
All right.
Ray, you ready?
Yeah, I'm ready. Let me hit share, and if you can unshare yours, and we'll be ready to rock and roll. And hopefully people can see it. When you got it?
Right, I can't unshare it.
All right. All right, folks. So thanks, Scott, for all that. We're going to get into the Greeks now. Now, I saw a couple of things going through the chats about, man, this is quick. All right. So what we wanted to do first off is give you an idea. Okay, what is a call? What is a put? All right. Put, long puts. When you're gonna get in, you're gonna look to a long put to make money and the stock goes up as the stock goes up. A long call or I'm sorry, a long call. A long put, look to make money on the trade when the stock goes down. Okay. You're going to buy a call. All right. You're going to pay a certain price for that premium, assuming the stock goes up and the premium increases on the call, then you can sell that contract to close the trade. All right. You don't have to go the whole length of the contract that you pick. All right. And we're going to get into that why here in just a second. And the inverse is true for the put. All right. You don't have to own the shares to buy a call or to buy a put. All right. You're simply trading a contract. Okay. That's all it is. It's a contract. You're buying a contract that gives you the right to buy shares if you want to. You don't have to buy the shares though. Okay. If the contract increases in value, you can sell that contract back to the market and you get to keep that difference. That's how you make your money. All right. The put. All right. When you buy a put, as Scott explained, you buy a put, say you pay a certain price for it. All right. The stock goes down in value. Well, the put will increase in value when the stock goes down. That's how a put works. Okay. So, for example, if you bought a put at $50 strike price, the stock goes down to 40, then that put increases $10 minus time decay, those kind of things. But let's say it increases $10. So now you can sell that put for the increase that it made, and you made money, okay, as the stock went down. Okay, so those are long calls, long puts. All right, now, so as Scott was going through, he's going, okay, now, so what are we looking for when the stock goes down? Okay, on Greeks. So we got Greeks, and I can't see my, there it goes. I'm going the wrong way. Okay, there we go. So we're going to do Greeks now. So the thing that Scott talked about in that premium is how does that option make money? How does it actually happen? Okay. He showed you that options chain, and we're going to get into that in a minute, but we're going to figure out what actually changes that premium in there. And Scott talked about intrinsic value and extrinsic value. Okay. So nothing really, only one thing changes intrinsic value. All right. Can anybody tell me what that is? There's only one thing that changes intrinsic value. Okay. And then we gave a hint. We explained to it earlier. Okay. We said that it's the stock price minus the strike price. So there's your hint. The stock price minus the strike price. So the only thing that can change intrinsic value is price, right? Okay. Extrinsic value is everything else. So the Greeks are going to help us understand what that is. Okay. Now I see time coming up on there. Time does not change intrinsic value. Okay. Time is extrinsic value. Okay. So what are these Greeks? All right. We're going to first determine how the changes in various factors impact the option premium. All right. And the option premium is two things, intrinsic and extrinsic value. Okay. So let's look at what these Greeks are. Now, usually when we're live on stage, Ben pulls me up there and he says I have a big giant truck and it has this cool dashboard and it tells me how things are running in the truck. Well, I don't have a truck anymore, but Scott has a truck. And I've been inside Scott's truck and he's got a very cool truck. All right. And it has those same cool dashboard. All right. And that dashboard, all right, has all these dials and stuff on it. Well, that's kind of what these dials are you're seeing right now on your screen. You got delta, gamma, theta, vega. Now here's the thing. This is only four of the 20 some odd plus Greeks that are out there. We're going to talk about four of them. Okay. We're not going to do all of them. All right. We're going to do four of these. We're going to do these four main ones here that most traders hear about as you go along. And that's the delta, gamma, theta, vega. All right. And this is what's going to help us understand, okay, what is it and how does it change that value, that option value? Okay. Because that's the thing that you all want to know. How does it change value? Because if I buy this call, I don't own the shares, don't have to own the shares. If I buy this call, I want that call option to increase in value. Is the bottom line. And you want it to increase in value on or before the expiration of that contract. All right. Because you're going to pick that. And And so how is it changing? So here's the thing. And this is why Scott didn't get into telling you which one you should buy. He gave you some parameters. He gave you some time parameters. You know, if you're going to buy an option, you want to be out there and own that option long enough, all right, to give that stock time to move in the direction you want it to move. Because if not, you may not be in the money at expiration. So you want to have that, okay? Now, um, when you're selling options to start the trade or open the trade, or you go short, like Scott was talking about, that's going to be coming up like tomorrow when we do covered calls and when we do the cash secured puts and the vertical spreads and those things later on in the week, right? That's the same thing you want to know though. Okay, are we going to be in or out of the money at expiration? Okay, typically for people that are selling options, okay, if you're going to sell an option to open the trade and you're shorting the option, okay, you're selling the option to open, you want that option to be worthless, all right, on or before expiration. That's right, worthless, okay. And I see what slide am I on? I'm on this slide right here in front. You should see Delta, Gamma, Theta, Vega, okay. Now, I'm just giving you an overview right now, folks, okay? So don't try to get ahead of yourself, okay? All right, so here we go. Let's get into what these Greeks mean. How are they going to affect the option itself? And then we'll get into how you use this to start selecting, okay, the trade. Because I saw earlier in the chats, well, which one should I buy? How far out should I go? Which strike should I get? All those kind of things. Well, Scott, does a great job teaching it, but he can't tell you that. Hopefully you see that I'm doing a fine job for teaching you too, but I can't tell you which one you should buy. You're going to buy and sell the option that's going to fit your trading style, okay? So let's go in here and let's look at the different Greeks. Here we go. We're going to start with delta. All right. So delta kind of has two meanings basically. The first one is this. The delta measures how sensitive an option is to $1 change in the price of the underlying. So when Scott was talking about that stock price being a certain price, all right, or the stock, is trading at $120, and he looked at the strike price that's at the money closest to that 120 value, okay? And you can see that strike, that delta was typically right around that 50 mark, okay? 55 to 49 or maybe a little below, but it's right there in the middle, okay? And so its sensitivity to the underlying stock, because remember, Scott said that an option is a derivative, and it's a derivative of the underlying. So that's what's getting its value. So when you see this and you go, okay, what is those options? How do they, what is that delta, and how do I pick which one I'm going to pick? Well, if you're picking a delta that's at, let's say 55, like this slide says, when the stock moves $1, the option premium, only the premium of the delta is charging this now, nothing else. So it's 55 cents. So it goes up $1, just like the slide here says. All right. You got a premium of 415, delta of 55. Your stock's at $65. It goes to 66. Now my premium is 470. Okay. My premium is 470. All right, right there. And so how did they get the 470? Well, the 415 plus the delta, it went up $1. Now it's at 470. So your option went up in value. Your option premium went up in value. Now, thing to remember about option values is they're all theoretical in price because, like I said, this is just one delta of the 26 different kinds of Greeks that are out there. All right. So if you're one of those, engineers and all those that need to know exact pricing all the time, all right, then and this can be a little bit daunting for you, okay? Just remember there's other things that are changing that value to premium besides just the delta only. We're going to get into four of them. We're going to get into gamma, theta, and vega here in a second. All right, but this is one thing I want to talk about in delta is how sensitive it is. So some folks, when they look at the option chain, and let's do that right now. Let's go up and look at the option chain. All right. And I'm going to go in, I'm going to collapse this left sidebar. All right. And then I'm going to go in and I'm going to look at, oh, let's look at Nike. All right. NKE. So I just type Nike up in the symbol up there. And then I'm going to go to the trade tab. Okay. When I go to the trade tab, and if I close these down, uh, and if you don't see the options, if you don't see the options chain on there under the trade tab, you got to go where it says option chain. Okay, far left side here, there's a little down arrow. It might look, if your screen looks like this, you got to open up the option chain by hitting that little caret right there. Okay, now this information right here where it says underlying, that's the underlying information of the stock itself. In this case, Nike. Okay, Nike. All right, now, if I go down to the open up the 17 July expiration, and I open up that little caret next to it because that's 39 days to go to expiration, that means these contracts will expire on the 17th of July. Okay, that's all it means. All right, you got 39 days till it happens. Down the middle here are your strike prices. Right down through the middle of the strike prices. This is where you're controlling the stock at with your option trade. Okay. And as Scott explained, bid ask prices. All right. If you hover over, by the way, it even says buy under the ask. If you hover over the value in the bid column, it says sell. Now you can see here I have eight strikes visible because in the middle I said strikes and I have eight in there. You can drop that menu down and you can do all of them if you like, and you can see a whole lot that are available, all right, for Nike at the 39 days to expiration value. The purple are in the money, the black are out of the money for the call side. In the money on the puts are purple, out of the money are the ones that are black for the put side on the right. Okay. So here we go. All right. So let's look at this delta. So this delta column right here, all right, you can see this delta goes from value in this case from 0.878990 down to down to 1 penny. Okay. Now remember, we said that the delta is a value of how sensitive the 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 option is to $1 move in the stock. Okay. So if you got an option that has a delta of 1 penny, do you think it's very sensitive, all right, to the movement of the stock? That's a no. 1 penny. You're going to gain 1 penny of value in your option for every dollar move the stock makes. 1 penny. Okay. So if you look at the delta of a stock itself, the delta of a stock is one, correct? Because if it moves $1, you get $1. Okay. So in this case, if you have a delta of 90, if the stock moves $1, then you're going to get a value of 90 cents, okay, on your premium to increase. All right, it would go up 90 cents. So we got to look at this. So as you start as a trader, as of your options trading, and you want to get in there, and you're going, okay, well, which one should I pick? Well, that's a you thing. Again, Scott or myself, we can't tell you what that is. All right. And so when we go in, if you say, well, if I want to go and I want to hire, make more money for my stock moves, I want my option to move a little bit higher, then I might want to pick the deltas that are more in the money or a little bit larger. Like in this case, 79 cents, 85 cents, 88 cents. All right. Or, if I want to go out of the money, you can see how dramatically it goes down. And now you're looking at, 8 cents for every dollar the stock moves. You're only going to get 8 cents. And look, this is a 57.50 strike. The stock's trading at $43. Okay, think of it this way. If you can't remember the in or out of the money, it's not even there yet. Okay, it's out of the money. It has no value, no intrinsic value. All it has is time value. Okay, so when you go in, this is what you're going to look for when you start saying, okay, which delta do I want to choose when I want to buy my call? If I want to go in and make a little bit more money on my premium as my stock moves, I'm going to go higher in my deltas. Okay. If I want to go a little lower, okay, because it's not as sensitive, okay, very sensitive to the movement of the stock price, not as sensitive down here. Okay. So that's how you can look at your delta. Same thing when it comes to the puts. Okay. Your delta column is right here. not very sensitive, more sensitive. Okay. So hopefully that makes sense for your deltas in that regard to that one. So let's go back to this and look at our second variation of what delta can do. Delta can also be a good proxy to estimate the probability, okay, the probability of success or probability that your option will be in the money at expiration. So Scott and I talked about earlier, you wanted to be in the money on or before you want to get out of that trade or before the expiration date. Okay. So in this case, if you saw the delta like we saw earlier and it's at the money, and it's a or a little bit, I'm sorry, a little bit out of the money and had a delta of 40. All right. That means you have about a 40% probability of that option having value or being in the money at expiration. 40% probability. Okay. Whereas when we showed you the ones that had 1 penny. So think of that. 1% probability of having value by expiration. Okay. That should tell you, okay, oh, okay, that makes sense now. Okay. Because that's how sensitive it is to that price movement. If you had that expiration of 89, an 89% probability of having value at expiration. So as a trader, as you're going along, let's look at this again. Let's go back up and look at the options chain. Here we go. So again, so if these are your probabilities of expiring in the money at expiration, and you got into this trade and you say, well, I want to go in and buy Nike. All right. I want to buy the $40 strike. The stock's currently at 43.23. Okay. But I'm going to go in. I think it's going to go up in value. Let's say that's your bias. You feel bullish. Okay. And you go, well, I think I'm going to buy it. So I want to buy the $40 strike. Okay. And it's got 39 days to expiration. It has a 69% probability of being in the money by expiration. Okay. On or before expiration. Okay. So that's how you can read that. All right. Whereas maybe if you have, if you're looking to say, well, I don't want to spend that much more money. I don't want to spend that high of a premium of $3.45, or as Scott taught you, one contract is 100 shares, so that's $345. Okay. Let's say you were saying, well, I only want to pay $18. Okay. But what is your probability of possibly making money by expiration? 5%. So that's what you got to start weighing. It's a balancing act, okay? It's a balancing act. You got to start weighing that as a trader of options. All right. So no one's saying you shouldn't trade out of the money options all the time. Okay. But this just means that your probabilities maybe not are not as good. I mean, we have a saying sometime, if you're always trading out of the money options, you're soon going to be out of money, right? All right. So and that's only, we're saying that only because, hey, this may not be a higher probability type trade. And they know I'm not trying to dismiss the put side. It's just there's the same exact thing, just inverse. Now, one of the things you see on the deltas on the put sides, you see minus signs in the front of them, okay? And that's okay, because all that's for, that little minus sign, all that's for is a designator. So if you go into your monitor tab, which we'll show you later, and you see that your deltas are negative, okay, it just means it's a put. That's all it means, okay? It just means it's a put. All right, so you'll see the negative on deltas when you have a put option going on, and you won't see one in front of the deltas of your call side, okay? All right, here we go. So those are your two factors when it comes to your deltas. All right, let's go to our next one. All right, and our next one is what's known as gamma. Now, we just taught this in San Diego this on Saturday, okay? And Ben Watson had a good comment on gamma. All right, gamma is a delta generator, okay? Gamma is a delta generator, okay? So when you see this thing, all right, gamma measures how much delta may change with each $1 move of the underlying. So gamma is really the delta of the delta, okay? Now, When it comes to gamma, here's how it works. Gamma is going to be the highest when you're at the money, and as you go further out or further in, it's going to go down a little bit. But gamma is going to increase. Okay, it'll start increasing in value a lot more as you get closer to expiration. Now, some of you may have heard of zero DTE options, or you may be trading zero DT options. That's 0 days till expiration. And when you're on 0 days to expiration, gamma is the thing that's going to either get you, because it's going to generate a lot of deltas, or it's going to take away. So gamma, you have to be on the right side of the trade. Okay, if you bought a call and you're close to expiration, and it starts moving away from you or going against you, all right, or the underlying stock is going down, okay, that gamma is increased in value a lot faster towards expiration. So gamma is going to take value away a lot faster in your premium than you would like, more than likely. Now, the inverse is true on the right side. If it's going up, it's going to start increasing that. So earlier, some of the chats, I saw a comment in there about, well, why wouldn't I want to just hold on to my option all the way to expiration? Okay. Well, one of the reasons is gamma, because if gamma goes against you just a little bit, okay, or the price goes against you just a little bit, when you're at expiration, it's going to hurt your premium a lot. Okay. And you may not want to put yourself in that situation. So that's where this comes into play. Let's look at it real quick. Okay. So let's go in here. Now I'm gonna change this back down to 8. Okay. And then you can see the gamma right here on the same stock, Nike, 17 July, 39 days out. Okay. We'll go right at the money here. All right. 45, 43 there. So we'll go right at the money. And that's our closest to at the money strike. All right. And you can see gamma is what? 5. And then right above and below, same thing. Then it gets lower as you go further out and further in the money. All right. Now let's do this. Let's open up the same stock. We're going to go here, 45. Let's look at 45 down here. And now look at gamma. Gamma is 10. Okay. So it's increased dramatically. Okay. And then as you get moving further in and out, what's happening to the price? The gamma is going higher and higher. If you opened up the 10 days to expiration, it's even higher because you're getting closer and closer to expiration. And remember, that's every day is going to happen. So if the stock goes up in value, is gamma going to help you on the call side? Yes, it is. But if it goes down, it's going to take away that same 14 cents. Okay, hope that makes sense. It's a generator or a remover of deltas depending on which way the price is going. Okay. All right. I'm looking at some of the chats, see if I can help you. Okay, you're looking good there. All right, so that's how things work when it comes to gamma. Okay, think of gamma as a generator or remover of deltas. All right, as you get closer to expiration, or if it goes in the right or wrong direction. So you got to be careful about that and understand. The thing to take away from gamma is understand that the closer you get to expiration, it increases more dramatically. Okay, increases more dramatically. Scott Durfey, anything you want to add there on gamma as we go through this? I think you might be on mute. I can't hear you.
I'm definitely on mute. There's some questions coming through on the chat about gamma. Is it really important? And stuff like that. And gang, these tools, not just gamma, but all of these tools. In fact, there are people saying, what about the other Greeks? If there's so many other Greeks, why are we only focusing on these one Greeks? These are the only Greeks. There's one other one, Rho, that really is associated with interest rates that affect option pricing. It's Black-Scholes model, and these are the Greeks that affect it. So, Ray, all of them you covered really, really well.
Mhm.
I would encourage us all to go back, especially those who are new, and potentially review not just your slides, but as this is again released, this recording's released, to go back and review that because the Greeks can be an extremely helpful tool in trading options, Ray.
Yeah. One of the things that, and Ben likes to do the songs up there, gamma's going to get you. All right. It's going to get you either way. Somebody had it in the chat there as well. So just understand about the gamma. And yeah, the gamma squeeze when you get towards the end, last couple of days before expiration, that's where that squeeze comes in because it's such a high number, it can really affect your premium very, very quickly. Okay.
Right,
Very, very
exactly.
quickly.
Hey, Ray, just real quick, do you mind going back to the platform and going back maybe to the let's go back to the yeah, right yeah, right there. So how do you put the Greeks on there?
Oh, all right. So the screen I have right now is up here on underneath this option chain where your line is. Okay, you can see where this is. It's a layout button. If you open that up, you can change your layout. And there, this I have Delta Gamma Theta Vega in there right now, so you can see the Greeks that we're talking about. And that's all I did. So here's Theo Price Mark. We'll get into that here in a second if we have time, and I'll show you how that works. But right now, Delta, Gamma, Theta, Vega. There you go.
That's also where I had in intrinsic and extrinsic value made that same change right there.
All right, our next one here is, I'm going to get moving. We got 15 minutes. The next movement here is Theta. Now, Theta, there's not many things you can say always about in the market. Theta is one of them. All right. Theta, you can always count on as taking away value of your premium. Isn't that great news? All right. Because the reason I say that's great news, because you know it's going to happen. Okay. It is going to happen no matter what. Every single day, you're going to lose value in your options. Now, so having said that, that means Theta as a seller of the options, okay, is your friend. Theta as a buyer of options is your enemy, so to speak, because it's taking away value as a long option, but it's helping you on the short option. Remember, we haven't got there yet, but short options, you'd like those typically to be at zero at expiration, worthless. So if Theta's taking away value every single day and the stock price never changes, all right. And by expiration, because theta is taking away all the value and your option is now gone, you're happy. So if you sold an option, you pulled $2 of premium in, theta takes away, takes away, takes away, takes away every single day. Okay. At the end of the time, even if the stock price never changed, hey, you're good to go. It's now worthless. The option goes away, honestly. All right. And then you have the premium that you sold when you started the trade. Okay. So that's why a lot of people like sellers of options or selling options, so to speak, a lot of times. Or they migrate to that. All right. So how does this work? All right. So when it comes to the option Greeks, all right, the closer you get to expiration, all right, the closer you get to expiration, then the higher, all right, the theta goes and your premium goes down, all right, starts increasing in value more dramatically. All right, so I want to show you one thing that Ben Watson has done, and this is probably one of the best slides that depicts this. Okay, think of think of this right here. I'm gonna try to draw some things on here, and maybe this will help. Okay. And let's do make this red so you can see it better. All right, so right down here, all right, is fire, okay? And this is expiration, okay? And we're up here. So when it comes times to, and you're a giant ice cube up here, okay? It's a big giant ice cube up here. Well, by the time this ice cube starts going down this way and gets close to this, the ice cube is going to get smaller and smaller and smaller because it's melting away faster and faster and faster. So when it's over here, it's not melting as fast. And this is how time decay works. It's not melting as fast the further out in time. And that's why when Scott and I were talking about, well, how far out do you want to buy options? 50, 150 days out, something like that can be very, very good. All right. So this is out here in time. And then when it comes to selling options, where do you want to be? Maybe in here. So let's think about this. So as a buyer of an option, maybe out here where you're more flat, okay? This is the time you want to be the buyer of an option, okay? All right, because this way, and if you want to take a screenshot when we're done, this might help you, okay? So what you're going to do is maybe, 150 to 50 days out, okay? Then as a seller of the options, okay, then you typically may want to be down here on this side, okay, of the table. All right, as you go down a little skewed there. Sorry about that. All right, and these are your seller of the options. All right, sell to open. All right, And the reason you want to do this, again, is for time value. And I'll show you here in just a second on the actual chain. So in this case, maybe this is, you know, 10, 20 days to 50, 40 days. All right. Maybe that's the time frame you want to be as a seller of an option. And the reason you do this is because as you get closer to that expiration, this increases, all right, the speed of which your time decay is occurring on your option. Okay. Increasing. All right. And so zero DTE, yeah, it's taking away value quickly. All right. So you got a balancing act. Theta's taking it away faster, but gamma could be increasing it if you're going the correct way on your gamma price. Okay. So let's see how this works. Let's clear all that off. All right. And then let's close this down. And let's see if we can show you how this effect works on an actual chain. All right. All right. Thank you. All right. So here we go. 10 days out. Look at this. All right. So theta, 4 cents. Okay. And again, the same thing happens on theta. The further you go out, all right, from the at the money options, that gets lower and lower. It's typically more at the money because there's more opportunity of which way it could go. All right. All right. Now then, look at this. As we get closer, all right. Now it's up 5 to 6 cents here. All right, on this particular one. If we change from Nike, let's look at Las Vegas Sands for the fun of it. All right, look at Las Vegas Sands, same thing. You can see here that you got 4 cents, 18 days out. Well, let's look down here. All right, 39 days out, 3 cents. Now it's 4 cents. Now it's 6 cents. Let's send them up the 4 days to expiration. All right, theta. Oh, look, now it's 11 and 12 cents. All right, so you can see how it's increasing value the closer you get to expiration. So know that as a trader and how you use that when it comes time to you selecting the strike that you want. Okay, because if you're going in there real close to expiration and you think, oh, I only have a few days, but look at theta could be taking away the value much faster. Okay. So understand that as well as you go into buying. So when you're a buyer of an option and you're going further out, going 74 days out, it's only 2 cents here. Okay. Only 2 cents. All right. So understand that going in. And that's why we say a good rule of thumb, maybe you buy more time, okay, when you're a buyer. And then when it comes to selling, you're going to go shorter time in value. Okay. Now, let's look at our last one. All right. Our last one is Vega. Okay. Vega. And that's not the little crazy car that Scott drove when he was in college. All right. Vega. Now, Vega, this is measures how sensitive an option is to the change in volatility of the underlying asset. So what does that mean? That turnover rate? How's the stock price moving? All right, what's going on with the price itself? Now, one thing that we give it away here. What's one thing that changes or makes volatility of what makes price change a lot when it comes to news coming out? Earnings. You can see right there. Whenever you see earnings, you see that volatility just spiking like crazy, don't you? All right, and that can help you when it comes time to understand which option you might want to buy. So for example, if volatility is high, all right, and volatility increases with that sensitivity, all right, like it says on the chart here, all right, then if you have a high volatility, do you think it's better to buy when volatility is high, or do you think it's better to buy when volatility is low? All right. Well, I'll give you a hint. It's typically better when it's low, okay? Low to increasing. So if you're buying low, that means the price of your option is a little bit cheaper, okay? And then as volatility increases, your premium increases. All right. If you're a seller of options, you would like to sell your option to open the trade when volatility is high, okay? And then dropping because you want the option to get cheaper when you're the seller of the option. Does that make sense? Okay, hopefully so. So let's look at that on the chain. So when it comes to the volatility, here's the thing to also remember. The further out in time you are with volatility, typically the volatility or vega is going to be a little bit higher the further out in time you go. Okay. And then as you get closer to expiration, it's going to be a little bit lower. Okay. You can see right here. All right. So just know that as well. The further out in time, Typically it's higher, okay? And then as you get closer to expiration, it'll go down in value. But you want to know, okay, well, what is that volatility number? Where are we? How do I know if volatility is high or low? Okay. Well, let's look at that. Let's close down some of these. We're going to go in and look at these normal ones here. All right. And if we look at this one, 17 July, you see up here, there's this 37.95, 37 or 37%, 38% volatility number, all right, implied volatility. All right, this five, this plus minus five is how much the market thinks or expects that stock could move, all right, on that for that month or that expiration. And this is the volatility level, 37 or almost 38%, all right, volatility. Now, you should be asking yourself, well, what does that mean? All right, is that high or low? Well, one of the things you can do, if you go over here to your charts tab and you go to Erlenmeyer Flask, okay, on charts tab, go to Erlenmeyer Flask right there. All right, click on that, and you can just type in IMP. All right, implied volatility. There it is, and double click that, and it'll put this chart right on your graph. Okay, puts that chart right there on the graph, and you can see this is telling you there it is. There's that about 38% tells you right where it's at. Okay, right what that option chain said. But you're going, but well, what does that tell me? Well, by looking at the chart, I would say that's about midway if its volatility value as compared to its volatility as a whole. So how can I look at the trade tab and get that figure so I know if my volatility is high or my volatility is low? Well, if you go to the bottom of your option chain, there's today's option statistics. If you open that up, all right, and you can see here it is, implied volatility 38, all right, 0.21%. This is what we talked about. But if you look at that, the current IV percentile is at a 43 percentile. Now, if you're in school, all right, or if your kids are in school and they come home and they go, Dad, all right, I'm in the 43 percentile in my grades. Are you going to be happy or pretty angry about his grade levels right now? Not too happy. He's in the lower range of that, okay? So that's the way you can find where you are. So here's one. Look at this one. AMAT. Real quick here. AMAT. Let's go to the bottom of this one. All right. It says it's 39 days out. It's at 67% volatility. Okay. Let's look at that one. Oh, look. Its IV percentile is at 96%. It's way up there. Okay. It's way up there. So do you think there's a lot of room for it to go up or for it to go down? All right. Go down typically. Okay. Because it's way up on top already. All right. So there you go. So how do you use all that? We'll start putting this all together this whole week now, going into our covered calls, going into our selling puts, going into our different aspects of how we want to go with regard to a trader. Okay. We're going to put all this information together, all the Greeks we just talked about, and how we now start selecting strike prices for the strategies that we're going to be looking for. Okay. Now, so consider when you're buying in options, all right, how far will the stock move? How long do I have to take that move? Is the volatility working in my favor? Is it low going up? And do I have a plan? What's my entries, exits, and so forth? Okay. And then if I'm the seller, same thing. How far do I expect the stock to go? All right. How long do I think it'll take to get there? Where's the volatility? And what's my plan? Okay. So there it is there's your Greeks. There's all kinds of wonderful webcasts on Greeks out there. As a matter of fact, if you go to the Trader Talks page and you just type in Greeks, okay? Hit Greeks, and you can see, look at all these Greeks right here. Look, you can understand Greeks in various types of trades. You got Ben Watson, Mr. May right here, okay? You got all kinds of great folks that are coming in. Brett is wonderful with this as well. You can see there's five of them right there that you can get into right away and start looking at Greeks and get a recovery of what we just talked about. All right, many of them out there. So take full advantage of that, folks. Take full advantage of that. All right, let's go back to our slideshow. Here we go. All right, Scott Durfey survey. Folks, here's the QR code for a survey. I know they've been dropping it into the chats as well. Give us a minute. Just a few questions. Let us know how we did today. We look at those. We try to improve every time we see this. Hopefully, you got some good insight on what an option is now and how an option price changes. And now you can start working on using that information to making your proper selection. You're not just guessing anymore of what you're doing when it comes to trading an option. All right. How about you, Scott Durfee?
Yeah, great job tonight, Ray. Great job, everybody, for being here too. Gang, we know sometimes this feels like you're drinking from a fire hose. Come back tomorrow. It'll be a great opportunity to kind of put together all of the things that we've been talking about here. Um, Also, gang, if you haven't already done so, please subscribe to the channel. So like and subscribe to the channel here. There's some big benefit to doing that. Part of that benefit is you'll get notified when these types of things come out again. We are recording this. It's many of you have been asking about that. So we should be able to get this up and down in the next few days. And so watch for it. Scott Thompson's been putting that link in as well. Thanks, Ray. Great job.
All right, man. Same bad time, same bad channel, right?
Yep,
Tomorrow?
we'll see y'all tomorrow night. Same bat time, same bat channel. Until then, everybody, happy trading. We'll see you tomorrow.
All right, see you tomorrow.